Right, hello everyone, and we are at the end of another week of trading. A pretty difficult week of trading. We're a bit up, bit down, a bit choppy, all lying in wait for the CPI print that we had yesterday. But we'll get back to that in a minute. We'll just start off the top end of the week. On Monday, we'd know a high impact date. As you can see, we get into Tuesday with some figures out of the UK. We did unemployment rate claim and count change, which is obviously the same as the or similar figure to the jobless claims in America. Not much to see there really. We got the unemployment rate ticking down by 0.1%. We then flick into GDP on Wednesday out of the UK, which showed a contraction over the month of August, which is obviously quite negative. We can see then the consensus at 0%. We were not expecting a contraction, but a contraction is what we got. But that has not taken centre stage when we think about the UK this week. What has taken centre stage is the dial back in the tax cuts from the government. They're considering winding back some of these tax cuts. It seems that Governor Bailey has won that argument and he might get his own way. Now, they obviously stepped in to buy a bunch of bonds to stabilise markets then last week. That is then due to end today, and we are also due an update at some point later on today about the potential tax cuts or potential reversal of some of these tax cuts that the UK government brought in a number of weeks ago. Kwasi Kwarteng is on his way back to the UK from America at the moment. I think he's still on his flight at the moment, so we've got no full clarity. We're still awaiting information off of that, but the rumours are that we will see a reversal of some of these tax cuts. Exactly what reversals we're going to see is still yet to be seen, so we will have to wait and see what we can find from that information later on. But UK related assets like it, sterling likes it, FTSE likes it, which is just basically reversal of what they did when these tax cuts were first announced. The FTSE got whacked, sterling got whacked, and now these moves are being reversed or have been reversed. So we are still waiting to see what the actual result is, but that is what we are expecting at some point over the course of today. If we look across the rest of the week, we didn't have a great deal. We had the minutes out on Wednesday out of the US, and they kind of stuck to the same script. The FOMC, they said that they need to continue raising interest rates in order to combat inflation, which is these central banks sound like a broken record at the moment, but that is the situation that we are in. They said they need to go a bit higher, and that when they reach the terminal rate, that the terminal rate is going to have to remain in place for some time. We've got to think. You come across the CPI then yesterday. We got the core the core rate of inflation, which excludes food and energy, so a little bit less volatile. The full rate of inflation did tick down slightly above consensus, but the core inflation rate, excluding food and energy, over the rest of the economy was still slightly higher. Now, the reason why interest rates are going to have to remain restrictive for a long time and going to have to remain at that terminal rate for a while is because if we think about this print in October of next year, if the core inflation rate, if the core CPI print is at 0% next year, that means this time next year we are still paying the prices, or in America they are still paying the prices that they are paying today. So we do need inflation to go back into negative territory to get it to come back down. 0% rate is just what it is now, which is obviously too high for it to be sustainable. So again, some strong inflation prints yesterday, some strong CPI prints yesterday, but we did have a report. We quite a bit of a mental day yesterday. I mean, if we just flick over to some charts, and just get the S&P 500 up. We'll just blow it up and stick it on an hourly chart. You can see then this move lower doesn't look like that much of a move once you see the bounce back after. But if you just measure it, from the high of this candle, or, certainly from where this candle opened down to the low, that's a 120 point drop, a 3.5% drop in the S&P. That is a massive move just off the back of one print. And then you can see the bounce back that we had, from the lows down here up to the highs. Then that's a 6% increase to 210 points. Now, we did have a bit of a bounce back after, which is to be expected. After you get a big flush out to the downside here, big move to the downside here, you do get a bit of a pullback. That's natural. That's to be expected after moves like that. But then this candle was a little bit unexpected. What we had was a model out the ECB, and in the ECB were suggesting, or rumors of a model out the ECB, they were suggesting that they do not need to keep hiking interest rates at they do not need to keep hiking interest rates at the current speed that they are in order to tame inflation. right? And that article was then, across the Squawk services, that was then reacted to, and that then pushed prices, pushed stocks higher, pushed risk assets higher off the back of that. And it really had some very, very strong upside between kind of 4 and 5 o'clock yesterday. In that candle there, you can see it kind of sustained that move overnight. Again, if the central banks do not have to raise interest rates at the speed that they currently are, that is then seen as a positive. That is then seen as a positive for stocks, and stocks then like that off the back of that. They suggested that a potential terminal rate of 2.25% in the out of the ECB might be enough, which is only a further 1% worth of rate hikes. You then get potential for a terminal rate maybe of 3% mid 2023 next year was the other suggestion, which shows that not that much more. Well, I say not that much more. That'd be another nearly couple of percent, which is fairly substantial rate hikes. But we kind of just been accustomed to 50, 75 basis point hikes in over the last number of months. So in terms of that, maybe not that much more. But I think the fact that it did come across and say that they potentially do not need to continue to hike rates at the current speed was what markets reacted to, and then rallied pretty strongly off the back of that. So that's something we need to keep in mind going forward. Although we are expecting now, off the back of that core CPI print yesterday out of the US, what we are expecting is a hike of 75 basis point twice into year end this year, and another one of 50 next year, before then calling it quits on the rate hikes and then keeping that rate for a while to come. So we still are expecting a further, that'd be 2.25%, sorry, mixing up my words, getting my maths a bit wrong, for the 2% worth of rate hikes in the US, which is still quite a substantial number of hikes. So in terms of, does that upside sustain itself, I don't know. I'm a little bit skeptical. I was a little bit skeptical of that move higher off the back of an ECB report. The ECB's economy is slightly different, but that's what we got yesterday. Does this roll over again? We'll have to see. But we did fail at these lows yesterday, and then pull back higher. But I think the bias still has to be bearish. In terms, it's a little bit more cloudy after that report yesterday, but I still think you're still in a pretty clear downtrend. Going back a while. We're still expecting a further 2% worth of hikes out of the Fed, and that is an environment that stocks are not favorable of. But talking about that, what we've also got failing, we've got these failing at the lows. We've got the US 10-year yield over here failing at 4%, so we're struggling up at 4%. We struggled to break it two occasions back here at the end of September, and then 1, 2, 3 occasions over the course of this week. So we are struggling up at that 4% level on the 10-year yield. I think that 4% level will be important. If we break above that, that should make stocks continue lower, then off the back of, or with continuation of these rate hikes. If we do pull back from that level and fail to break above that, that should prove supportive for stocks, certainly in the short term anyway. So I think that is definitely a chart that we need to keep an eye on. This euro dollar chart finished higher yesterday off the back of that report. Again, over the course of this week, it's been pretty choppy up until yesterday, and then yesterday was down and up and down and up. So a little bit difficult to read into the price action there, but I still think the bias is slightly bearish on euro dollar, I think, if I'm being perfectly honest. We'll come across the dollar yen though. Dollar yen is quite an interesting chart. That 145 level that was defended by the Bank of Japan has now folded. Now we've got to remember that yield curve control is still in place in Japan and is showing no signs of stopping, and the Bank of Japan tried to stop at a 145 and tried to send it back lower, but the fact that they are keeping that 10-year yield anchored close to 0% with that upper band of 0.25%, and you've got yields elevated across the world, I think really the only reason to get that to turn around is probably to remove yield curve control out of Japan, and that shows no signs of happening anytime soon. So the bias is still probably tilted higher on that, and we'll have to keep an eye on it, see how that plays out going forward. But the bias probably has to remain higher off the back of that. You jump on the charts, it's in an uptrend across every single time frame that you look at. You then look at the fundamentals behind it. Further rate hikes expected in the US, no rate hikes expected in Japan. That's just a recipe for this chart to continue higher, and it was quite a vain attempt from the Bank of Japan to keep a lid on that 145, but that has folded over the course of this week. and it's definitely something worth keeping an eye on into next week. Speaking of next week, we'll flick on into next week. We're not got a massive deal out on the economic calendar. We do have a CPI print out of the UK on Wednesday. That's probably the main focus of attention on the calendar. Not a great deal out of not a great deal of information out of the calendar next week. We do have the National Congress of the Chinese Communist Party going on all week, as you can see. We're expecting Xi Jinping to go for an unprecedented third term as leader of the Communist Party. We are kind of awaiting updates on whether he gets more power within the party. We are awaiting information on how he is going to deal with China's COVID-0 policy and the damage that is doing to the economy, and also then the situation with Taiwan, what he plans to do with Taiwan. So there's a couple of bits of information out of China next week. May affect the global markets, may give us some risk on, risk off. Should certainly affect the Aussie and the Kiwi, or should probably affect the Aussie and the Kiwi, as they are quite highly linked to the goings on in the Chinese economy. So a couple of things we can watch out for next week, but really not a great deal across the calendar. Looks a bit busier than it actually is. We'll cross that bridge next week though when it comes to it. I think a little bit tricky price action to work out this week. It was slightly choppy, well, very choppy to begin the week, and we got to yesterday, and then it was, crazy day yesterday, pretty insane day yesterday, certainly across the equity space anyway, and a little bit difficult to predict some direction into this week, but I think the bias probably still remains short stocks and long the dollar. How long that lasts for is a different question, but that's where the trends are. We're still expecting rate hikes out of the Fed, and if I have learned anything, or if any of us should learn anything over the last number of months, it is don't fight the Fed. So yeah, if they are going to continue hiking interest rates, that's probably the side of the market to sit on. Anyways, I'm going to wrap it up there then, folks. Have a good weekend. Do recharge the batteries, and we will be back next week for another week of trading. Thank you.